If I was starting over as an investor in today's crazy stock market, there are only 3 things that I would buy, and I'm going to show you in this video. No, I wouldn't try to find the next Nvidia or the next hot AI stock. No, I wouldn't do any stock trading or Forex or options trading. In fact, I wouldn't invest in any individual stocks at all. I wouldn't buy Amazon, I wouldn't buy Apple, I wouldn't buy Nvidia. If I was a brand new investor, I would only focus on these 3 ETFs. An ETF is an exchange traded fund. That means instead of investing in an individual company like, say, Amazon, which has the AMZN ticker symbol, I'm investing into this fund which owns several companies, such as Amazon and Apple and McDonald's and Coca-Cola and Visa and Tesla and hundreds of other companies. The reason why I'm saying this, especially as a beginner investor, is because when I invest in an individual company like, say, Amazon, now I am managing my investment, because now I have to make sure that Amazon is growing. I have to make sure that Amazon is innovating. I have to monitor the financials of Amazon. I have to study their financial statements. I have to study what the company is doing, because if I don't and Amazon then ends up bankrupt, I lose all of my money. Sure, if I get it right, I would make a lot of money, but now I'm gambling if I don't know what I'm doing. And you might say, well, Jaspreet, Amazon's not going to go bankrupt. They're the biggest retailer in the world. Well, that's exactly what people said about Sears. A couple decades ago, they were the biggest retailer in the world, and then they ended up bankrupt. Things change with time, and technology changes things even faster. And when you're investing in individual companies, that's great. But now there's more work and more research, which if I'm just getting started, I might not want to do that. Versus when I invest in a fund, now I have less risk, because if Amazon were to go bankrupt, this fund is now being managed by somebody or something else. And that means now this fund would then kick Amazon out and replace it with a different company, and I don't have to do anything. I own the fund, and this fund is being managed by an algorithm or by a person, and I don't have to worry about it. I can just keep working to accumulate more shares of this fund and hopefully see my wealth grow. But now, instead of talking in theory, let me actually go over which funds I'm talking about. But I gotta give you a disclaimer. I'm not a financial advisor. I'm just a random guy on YouTube. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. The first ETF that I would consider investing in is an S&P 500 ETF. A couple examples here are SPY and VOO. I'm personally invested in VOO as a disclaimer. These are 2 different ETFs that give you both exposure into the S&P 500, and I'll explain the differences in just a second. The S&P 500 is a group of the 500 largest companies in the stock market. And the reason why I like this is because now you're not just investing in the total stock market, you are investing in the 500 largest companies. And now you're essentially investing in some of the largest companies that make America America. The second reason why I like these ETFs is because they have a low expense ratio. An expense ratio is the fee you have to pay for investing in an ETF, because now you're paying somebody or something to manage this fund for you. Remember, if you're going out and buying the Amazon stock yourself, or you're going out and buying the Apple stock yourself, you are the manager. You have to keep up with these stocks. You have to decide when to sell one of them, when to cut your share, when to buy more. Versus when you invest in a fund, you're not managing it, you're just owning the fund and buying more shares of the fund. So you pay that fund a fee called an expense ratio. And the expense ratio on SPY is 0.09%. On VOO, it's 0.03%, which means for every $100 I invest, I'm going to pay 9 cents in fees every year to SPY. I'm going to pay 3 cents in fees to VOO. Now, I want to make sure that this is explicitly clear. When you invest your money, your investments are not going to go straight up. Markets go up, markets go down. What you're doing here is you're just investing in the broad 500 largest companies in the stock market. And if the stock market is going up, well, generally these funds will also go up. But if the stock market's going down, these funds will also go down. And you have to remember, markets go up and down. We see market crashes, we see market booms, we see economic crashes, we also see economic booms. So this is kind of a way to give you exposure to the broad economy, the broad market. And it's not a way to guarantee a profit tomorrow. But if we take a look at history, what we have seen is that the S&P 500 over the last 100 years has averaged more than 10% a year. It doesn't mean that it goes up by 10% every single year. That means despite the market crashes, despite the recessions, we have seen more than a 10% gain every year on average. A minute ago, I said I'd tell you the difference between SPY and VOO, and the biggest difference isn't which companies they invest in, because they're both primarily investing in the same 500 companies, but the difference here is this expense ratio. This is one of the biggest differences. VOO has a smaller expense ratio, which attracted me. But there are some other slight differences in that SPY might put more money into certain stocks versus VOO put more emphasis on other stocks. But that's something that you can do your own due diligence on. But essentially, with both of these funds, you're getting exposure to similar, if not the exact same 500 companies. There might be a different allocation for certain companies over others, and they have similar expense ratios, but VOO is slightly less. This brings us to the second type of ETF that I want to talk about, which has to do with dividends, and I'm going to go over two different ETFs again here, kind of as an added bonus. Now, for those of you that are investors or want to become investors, I want to remind you that my team at Briefs Media publishes a free daily newsletter called Market Briefs, where we break down what's happening in things like the economy, the stock market, the housing market, crypto, and the global economy into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that read Market Briefs every morning. Plus, when you join Market Briefs, you'll also get our investing masterclass as a bonus for free, just for joining Market Briefs. So if you want to get Market Briefs plus watch our investing masterclass as a bonus, all you have to do is click the link down in the description below. I am a huge fan of dividends because I love investing for cash flow. Cash flow means I make an investment today. I invest $100 today, and now I don't have to wait for my investment to go up to $200 to make a profit. I start making money because the thing that I invested in is sending me a check, either every month or every 3 months or every year. When it comes to the stock market, this check comes every 3 months, and it's not actually a physical check, it's a direct deposit into your account, and this is called a dividend because some companies in the stock market have a ton of profit. For example, McDonald's has billions of dollars of profit in their bank account at the end of the year. Now, when they have these billions of dollars, they can do 3 things with these billions of dollars. They can reinvest this money back into their own company. They can work to create better hamburgers. They can, number 2, save this money for an emergency. So they can keep this money in extra savings in case there's something bad that happens in the future. Or they can also do, number 3, they can just give it away to the shareholders, to their investors. And a good company is going to do a little bit of all 3. So there are some companies out there that have these huge profits where they just give a big chunk of it away in the form of a dividend, where they literally will deposit money into your bank account for doing nothing except owning that right stock. Now again, you can go out and invest in those individual companies, or you can invest in a fund that specializes in dividends. Now, I want to give you the pros and the cons here. The reason why I like dividends is because it gives me a sense of security, because now, after some time, and after a number of years, what you'll see is those dividends can start to stack up. And my goal is to be able to just live off of my cash flow, to live off of my dividend income, to live off of my rental property income, because now that cash flow from my investments that comes in pretty much passively can fund my life. And now I can use that money to buy my car, to pay for my housing, to pay for my vacations, and really anything that I want, and I don't have to work to earn that money. I worked to buy those investments. The reason why a lot of people don't like these dividends is because it's so slow in the beginning. You're going to invest money this year, next year, the year after that, and see little to no return. It really takes years, if not a decade, to starting to see the real impact of these dividends if you don't have a ton of money to start with. Plus, number 2, you have to think about taxes when you get dividend income, because when you get that dividend income, you have to pay taxes on that dividends, even if you reinvest that dividend income. So whether you like dividends or hate dividends, that's up to you. I love dividends, so I'm going to talk about a couple dividend ETFs, 2 very different ETFs. By the way, I'm personally invested in both of these. So SCHD and VYMI. SCHD is a dividend-paying fund created by Charles Schwab, and this is investing in United States dividend-paying companies. So Charles Schwab is the fund manager here, and they go out and they find high dividend-paying companies in the United States. They invest in those companies that are paying out a dividend. That way you can get a steady and strong dividend with this fund. Does that mean that the fund always goes up? No. Does that mean the dividends always go up? No. You're going to see variations, just like stock prices. Stocks go up and down, dividends can go up and down, but over the long term, the goal is to see your investment value go up and your dividends also go up. Of course, investing is risky, but that's the goal with SCHD. VYMI is created by Vanguard, and this one's a little bit interesting, which is why I wanted to mention it, because this is investing in high dividend paying companies outside of the United States. So non-United States companies that are paying out these higher dividends. So more speculative here, but the reason why I want to talk about this is because sometimes, especially if you're starting off, you want to have a little bit more risk on your portfolio. And now when you're investing in these non-US companies, you can see the growth, not just of the company, but also of the country. So if some of these countries start to see more growth, those companies can also see more growth, and you can see faster growth in those dividends. So this is more risky, but more potential to see more growth in those dividends as well. Again, you got to know your game. You might hate the idea of investing in dividends. You might love the idea of investing in dividends. This is just a way for you to start thinking about, as you're building your portfolio, what are some of the things that you may want to invest in? For me, I want to own some of the S&P 500. I want to own some dividends, which also brings me to number 3, the growth fund. Growth companies are different than both of these because growth companies generally don't have a lot of profits, if any. These are companies that are working to grow as big as possible, as fast as possible, so they're taking their profits and reinvesting it back into the company, which means there's more risk for more potential return. And that means there's a chance that the companies inside of these funds can go bankrupt a whole lot faster, but if it goes well, those companies can also grow a whole lot more faster. So growth funds are more risky for more potential, keyword potential return. A couple options here are QQQ and VUG. QQQ gives the exposure to the NASDAQ. You may have heard that term before. The NASDAQ is a group of the 100 largest companies in the stock market that are not financial. That's the key, not financial. That means most of the companies in the NASDAQ are actually tech companies, and these are a lot of companies that are innovating, trying to grow bigger, trying to go faster because they're innovating on the tech side of things. Then we have VUG. This is created by Vanguard, and this is a growth fund that's investing in those types of growth, startup-y type of companies. So these growth funds, these growth stocks are more risky, more speculative, for more potential return. And then we have the S&P 500 and dividends, which are a little bit more on the safer side. And this is why I say personal finance is personal because, well, your goals are going to be different than somebody else's. Some of you might hate dividends. Some of you might love dividends. Some of you might want more risk. Some of you might want less risk. And this, I'm going to give you one more bonus. This is a bonus ETF that you can consider investing in for those of you that believe in a particular niche. The nice thing about ETFs is there's an ETF for almost anything. So if you believe in a particular industry, if you believe the markets are shifting towards one particular direction, that can create an investment opportunity. But if you don't know which company to invest in that shift, well, you can just invest in a fund that gives the exposure to the broad shift. I'll give you an example. BOTZ, bots. This is an ETF that gives you exposure to AI and robotics. So if that's something that you believe in for the next 5, 10, 20 years, you don't have to find the perfect company. There are ETFs that give you exposure to that. Another example is AGNG, aging. There is a growing demographic of older people in America who are, well, getting older. And those older people are going to need different services, different healthcare, different needs. This ETF invests in those companies that service older people. So essentially it profits off of people becoming older. If you believe that's a shift that's going to become more profitable in the future, that's something that you can consider investing in. IYG. This is an ETF that gives you exposure to financial services. So if you believe in the future of banking and financial services, well, this is an ETF that can give you exposure to that. The reason why I'm showing you this is there are ETFs for anything. So if you want to invest in an area where you believe money is moving, well, that doesn't mean that you can't do it if you want to invest in ETFs. In fact, there's ETFs for pretty much anything that you can imagine, and this can give you the opportunity to diversify within that niche as well. But this is where you have to kind of know how you're going to allocate your money, because the reality is this niche ETF is more risky, and you have to know how much risk you're willing to take on. Yeah, if you're 19 years old, you can take on more risk. As you get older, you might not want as much risk. You have to know your tolerance for risk, what type of returns you want, and are you willing to withstand the ups and the downs? Because the way that you win as an investor who's investing in ETFs is not to invest $10,000 today and then hope that this money becomes $1 million when you retire. That's not the way that you do it. The way that you win is by following a strategy that many people call DCA, dollar cost averaging. I like to call it ABB, always be buying. That means you set up a cadence. That's consistent, passive, and automatic. CPA, consistent, passive, and automatic. Money is pulled out of your checking account and invested into your portfolio of ETFs, into your portfolio of funds, and you set it and forget it. Maybe it's once a week. Maybe it's once every 2 weeks. Maybe it's once every 4 weeks. You pick a cadence and you set it and forget it. For me, what I do is once a week. I do it on Wednesdays. There's no secret science as to why. It's just in the middle of the week. Every Wednesday, money is pulled out of my checking account and is automatically invested into my portfolio of ETFs, no matter what. It doesn't matter if the markets are going up. It doesn't matter if the markets are going down. It doesn't matter if markets are crashing. It doesn't matter if markets are booming. It doesn't matter if we have a Republican in the White House. It doesn't matter if you have a Democrat in the White House. It doesn't matter what's happening. I just keep buying. And I want you to remember this because anytime we start to see a downturn in the markets, I get the questions. Jaspreet, should I be selling everything right now? Should I stop buying? When in reality, the only time you might want to change your strategy is when you're going through a recession, when you're going through a downturn. Maybe buy some more. Because remember, you have to be a long-term investor. You have to have at least 10 years, if not 20 or 30 or 40 years, to really see the growth, but at least 10 years. And if you have 10 years plus on your investment horizon, a recession doesn't change your investing plan. You just keep investing your money, and the only change you might want to make is potentially buy more. Because when markets go down, it gives you the opportunity to buy more good investments at a discounted price. When things go down, markets crash. We saw it happen multiple times in 2025. We saw it happen in 2022. We saw it happen in 2020. Well, that creates the opportunity for you to come in and buy good investments at a discounted price. Now, we don't know how long a downturn will last. We've seen more than one recession per decade for the last 100 years. In fact, we've seen 16 recessions over the last 100 years. We've seen 25 market crashes over the last 100 years. We're going to continue seeing it happen in the future. You want to use them as buying opportunities to buy good investments for the long term, but you have to know what it is that you want to invest in the first place. So if you're just getting started as an investor, you don't know how to research companies, you don't know how to study the financials, and if that's not something that you're interested in, that's okay. You don't have to. You can just get started by investing your money into the broad stock market. And then as you get more involved, more sophisticated, more educated, well, now you can start to see how involved you want to be with your investments, if you want to actually manage your investments yourself, or if it's okay with you just investing in funds. Nothing is wrong, nothing is right, you just have to get started. The reason why so many people don't build wealth isn't because they made the wrong investment, it's because they didn't invest their money in the first place. The key is to get started. As you get started, work to optimize from there. You're not going to be perfect in the beginning. You are going to make mistakes. You are going to lose money. Markets will go down and you will pick a bad investment. That's part of the game. Don't blindly trust what any random guy on YouTube says because what's right for me is not going to be right for you. I just want you to start thinking like an investor, start putting your money to work, and then find the right investments for you and your family. That way you can build wealth for yourself as well. If you have $100 in your bank account and you want to buy this $1,000 Gucci scarf, your bank would love to lend you the $900 at 25% APR because when you make the minimum monthly payments, your banker gets richer. But that's just the beginning. When it's time for you to buy a house, who do you ask? How big of a house should I buy? Many times it's your banker, and they're not your financial